Chapter 8 Stock Valuation. In this chapter, I will explain the role that a company's future plays in the stock valuation process. I will talk about how to develop forecasts of the stock expected cash flow, starting with corporate sales and earnings, and then moving to expected dividends and share price. I will discuss the concept of intrinsic value and required rate of return and note how they are used. I will talk about how to determine the underlying value of a stock using a zero growth, constant growth, and variable growth dividend valuation models. I'll talk briefly about how to use other types of present value-based model to derive the value of a stock, as well as alternative price-related procedures. I hope that you will understand the procedures used to value different types of stock, from traditional dividend-paying shares to more growth-oriented stock. So what is valuation? The valuation is the action that the investor attempts to resolve the questions of whether and to what extent a stock is under or overvalued by comparing its current market price to the intrinsic value. So in this chapter, we'll talk about how to value a company based on its future performance. We will learn how to develop a forecast of a company based on its financial performance, and we will talk about the valuation process. For stock valuation, the future matters more than the past because the price of the share of the stock or the intrinsic value depends on investor expectations about the future performance of the company. However, the only thing that we can observe is the past. So we have to take a look at the past performance in order to gain insight about the firm's future directions. Therefore, we have to use the historical data to project key financial variables into the future. The key to the forecast is the company future performance, and two important features that the investor should be able to anticipate is the sales and profit. In order to forecast future sale, the investor can approach the naive approach here. According to this approach, investors assume that a sale will grow as they have in the past and extend the historical trend. Of course, if there is different evidence based on the economic situations or the industry situations, or something different, something new about the company information, then the investor should change the growth rate and not rely entirely on the historical performance. Once we have done forecasting the sales, we can move to the next thing, which is the net profit margin. We would like to know how much money that the company will earn or will have in terms of profit based on the future sales. In order to do so, it's a good idea that we take a look at the common size income statement. So what is a common size income statement? In this statement, it takes every entry found on an ordinary income statement or balance sheet and convert it into percentages. For example, we can divide every item on the income statement by the sales. When we look at the common size income statement, we will be able to identify changes in profit margins, and we can highlight possible causes of those changes. And based on that, we can make projections of future profits. In Table 8.1, we have an example of common size income statement of a company named Universal Office Furnishings Incorporated, 2016 income statement. So the first column here, we have an ordinary income statement. And the second column here is the common size income statement. It divides every item here by the net sale. So the net sale is 100%, and the cost of goods sold takes account for more than half of the net sales. So the gross operating profit is 41.8%, etc. and etc. We have different items has been divided by sales here. After we have been able to get the sales forecast, and we can estimate the net profit margin, then we can combine this to arrive at the future earnings. We have the equation 8.1. The future after-tax earnings in year T will equal to the estimated sales multiplied with the net profit margin. So up to this point, we have been able to derive from some forecasts, which provide some insights into the company's future earnings. The next step is to evaluate how this result will influence the company's stock price. In order to do so, the investor needs 3 additional pieces of information. The first thing is an estimate of future dividend payout ratio. And when we get the dividend payout ratio, we are projecting the firm's recent experience into the future, unless there's other evidence to contrary. It means that if the company do not pay dividend, or it's just a startup company and it has no history of paying dividend before that, then we will not be able to estimate the future dividend payout ratio because we can't find any insight from the past. The second piece of information that the investor should find is the number of common shares that will be outstanding over the forecast period. This information will not likely to change from one year to the next. Maybe we can just use the current number in the forecast until announcements otherwise are made. Only when the company announced to issue more securities or buy back its security, it will have an impact on the number of outstanding shares. So if the company do not have announced any such things, then we do not have to care about the change in the number of outstanding shares in the market. And the third thing that the investor should collect is the future price to earning or PE ratio. This one will be more difficult to estimate. So we will talk about more PE ratio in the next slide. The most difficult phase in this process is to derive an estimations of PE ratio. So first we have to understand the determinants of PE ratio. So the PE ratios is a function of several variables. We have the growth rates of earnings. We have the general state of the market. We have the amount of debt in the company's capital structure. We have the current and projected rate of inflation. And last but not least, we have the level of dividends. So regarding our growth rate in earnings or the general state of the market, the first two here, they have a positive relationship with the PE ratio because the high PE ratio will be associated with high growth rate in earning, or associated with an optimistic state of the market. So those two have a positive relationship with the PE ratio. And the lower the debt, then the higher the PE ratio. The current and projected rate of inflation will have a downward pressure on the stock prices and the PE as well. So the current and projected rate of inflation will have a negative impact on the PE ratio. And last but not least, we have some evidence that most companies with high PE ratio have low dividend payout because they have to pay less money so they can retain more money to invest to growth in the future. And that's why when they have a low level of dividends, they will have a high PE ratio or high prospect of earning growth. In order to estimate the PE ratio, a good start is to take a look at the average market multiple. The average market multiple is the average PE ratio of all the stocks in a given market index. For example, in the US, we have S&P 500 or the Dow Jones Industrial Average. And the meaning of average market multiple is that it indicates general state of the market. It can tell the investor that how aggressively the market is pricing stocks. If all else equal, a higher PE ratio signal an optimistic market. However, the increases in PE ratio do not necessarily indicate a bull market. For example, in 2009, 1 year after the financial crisis, then the earnings is very low, and it makes the PE ratio spikes. But a high PE ratio at that time of the year has nothing to do with a positive prospect or the optimistic in the market. It's just because the earning of last year is very low. The figure 8.1 here, it illustrates average PE ratio of S&P 500 stocks. In order to get this figure, the author of this book have divided the stock prices at the beginning of the year by the previous 12 months earnings. So from this period, as you can see, the PE ratio fluctuates, but not so much. But it have two peaks and the all-time high in 2009. And after just a short period of time, the PE ratio of this maybe 70, it have dropped to around maybe 15 or 20. So it is quite a drop here. It is because the peak of PE ratio in 2009 does not signal with increasing stock prices during the year. It happens because of the earnings have been extremely low due to the severe financial recession in 2008. So when taking a look at figure 8.1, the investor should be careful when interpreting the PE ratio. So after we have had the market multiple, we can use it as a benchmark and calculate the relative PE multiple. So the investor calculates this relative PE multiple to evaluate the stock PE performance relative to the market, simply by dividing the stock PE by the market multiple. For example, if the stock have PE of 35 and the market PE is 25, then the stock have a relative PE is 35 divided by 25, and we have 1.4. The meanings of relative PE is that the higher the relative PE, the higher the stock will be priced in the market. However, high relative PE multiple can also mean lots of price volatility. It means that the price can fluctuate a lot. So the next step is to forecast the stock future PE over the anticipated investment horizon. In order to do so, we can use existing PE multiple as a base, and then we can adjust that base up or down based on investor expectation. We have talked about how to estimate the dividend payout ratio, about how to estimate the number of outstanding shares, and how to estimate the PE multiple. Now we can move to the next part to estimate the earning per shares or EPS. So according to equation 8.2, the estimated earning per share is equal to the estimated after-tax earnings divided by number of outstanding shares. And we can also use equation 8.3. The equation 8.3 yields the same results as equation 8.2. However, it offers an advantage over the equation 8.2. According to equation 8.3, you can see that here the EPS is calculated by the first component, which is the after-tax earning divided by book value of equity, and we have it as return on equity or ROE. And the second component is the book value of equity divided by shares outstanding, and it is book value per shares. So according to equation 8.3, we can see that how profitability of the firm, or proxy by the return on equity, contribute to the expected earnings per shares of that firm. So it kind of gives a additional perspective compared to the equation 8.2. So eventually, after adjusting based on our judgment, we will come up with an EPS that we feel comfortable with. And after we have the estimated EPS, we can estimate the payout ratio, and then we can get the dividend per shares. Now we will see all the components we have been estimating so far, how they will fit together. So the final step is to estimate the future value of the stock. So we can use equation 8.5. The estimated share price equal to the estimated EPS multiplied with the estimated PE ratio. So the estimated share price is the thing that we care about, or something which is very important because it's had embedded in the capital gain portion of the stock's total return. So now let's take a look at two tables, the table 8.2 and table 8.3. In order to get the forecast of this company, you should follow these steps. First, you should take a look at the company dimensions, like sales and revenue. You estimate them first, and then you estimate the net profit margin. You move to the net earnings, and you move to the number of outstanding shares. After you get everything in the first step, you can move on to the second step, which is estimating EPS divided by the expected earnings by the shares outstanding, and you get the estimated earning per shares. You anticipate the dividends, and you anticipate the price of the shares. So in here in the table 8.2, you got the historical financial data. Remember that this is the historical data. So this is totally what happened in the past. But you selected some of the historical data in here. For example, the total asset, and you can calculate the total asset turnover. You get the sales revenues, and you can calculate the annual rate of growth in sales. In order to do so, let's take a look at this one. You find the annual rate of growth, divide sales in 1 year by sales in the previous year, and then subtract 1. So they give you the example how to calculate the annual rate of growth in sales. And then you calculate the net profit margin. You get the payout ratio, you get the PE, and then you get the number of outstanding shares. Those are the selected financial data. So in here we have the summary forecast statistic for this company. First, take a look at the actual figure from the fiscal 2016. And we have the annual growth in sale, which is 9.7%. We have the net sale here, and when we multiply the net sale with net profit margin, we get the after-tax earnings. We use the after-tax earnings divided by the common shares outstanding. We get the EPS here, and we multiply the EPS with payout ratio. We get the dividend per shares, or DVS. And we get the earning per shares multiplied with PE. We get the share price at the end of 2016. So this is the historical data. This is the weighted average for 5 years from 2012 to 2016. So we use that weighted average as a proxy to estimate what will happen in the upcoming years. First, we will forecast the growth rate of sales. So assuming that we predict the economic situations will be uprising in the future, so we assume that in the next year this company will have a pretty high growth rate in sale, and we anticipate that it will be 22% for 2017. And this growth rate will decrease and retain a more decent growth rate in the following years. For example, in 2018, the growth rate will be 19%, and 2019 it will be 15%. So we get the annual growth rate here. We multiply with the previous net sales. We will get the net sale for the predicted years, like this. For example, in the star here, it had explained the way to calculate the net sale from the estimated growth rate. The second thing to forecast is the net profit margin. We predict that the industry and the company will have a comfortable improvement in earnings. So we will use a growth net profit margin of around 8%. It's a little bit up from the 7.2% in 2016. We project this due to some improvement prospects in the company and industry situations. And the next thing to anticipate is the common shares outstanding. The weighted average is around more than 70 millions. In 2016, the number is nearly 62 millions, and we forecast the number of outstanding shares around 60 millions like this. The company states that it will continue to buy back some of its shares, so the number of outstanding shares will be a little bit lower from the weighted average of 5 years. So we anticipate it will be around 60 millions. In terms of the payout ratio here, we assume that the dividend payout ratio will hold at a steady rate of 6%. So it's somehow very close to the last year figure and close to the weighted average of 5 years here. So we assume that the payout ratio will be approximately 6%. The PE ratio, we will forecast this one based on the estimates of improved growth in revenue and earnings. We project that the PE ratio will rise from its present level, which is 18.4 to 20 in 3 upcoming years. So we have the earning per shares for 3 years. We have the PE ratio estimate 1 for 3 years. And so we can get the anticipated share price at the end of 3 years. So what is the valuation? Valuation is a process by which an investor determines the worth of a security, keeping in mind the trade-off between risk and return. In terms of common stock, the essence of valuation is to determine key input, such as future cash flows, the timing of this cash flow, and the rate of return required on the investment. Towards that end, we employ various types of stock valuation model, and the end product of this represents the intrinsic value we have been seeking for. So the valuation model will help us to determine the expected rate of return or the intrinsic worth of shares. So when we get the expected rate of return or we get the intrinsic value, what should we do? We will consider if the investment is a worthwhile investment or not. So the stock could be a worthwhile investment if once the expected rate of return equal or exceeds the return we feel is warranted given by the stock risk, or the justified price, or we call it the intrinsic value, is equal or greater than the current market price. So to put it another way, the market is undervalue the stock. So in that case, our stock will be a worthwhile investment. However, for all the troublesome we have encountered, there's no assurance that the actual outcome will match our expected or projected outcome. In order to find the intrinsic value of the stock, we have to determine the cash flow, the timing of the cash flow, and the required rate of return. In order to determine the required rate of return, first we have to define what it is. So the required rate of return is the return that an investment requires to compensate them for the investment risk. There's several ways to determine the required rate of return, and we have the equation 8.6, which points out one way to determine it. So according to equation 8.6, this is the result of the capital pricing model, and the required rate of return will be estimated using the risk-free rate plus the stock beta multiplied with the market risk premium. And the market risk premium is defined as the difference between the market return and the risk-free rate. So let's talk a little bit more about each component in this equation 8.6. First, we have the stock beta. This one can be calculated by ourselves, or we can obtain it from many online websites. And many websites, many company, many securities company has already calculated this one, and we can just use it. And the second one is the risk-free rate. This one is defined as the current return provided by a risk-free investment. And talking about risk-free, we have to keep in mind that this type of rate can be proceed by treasury bill or treasury bond in the US market. But if we calculate the required rate of return for the stock in another market, aside US market, we can use the T-bill or T-bond in US market as well, but we have to take into account some country risk. And the third component here we have the market return. This one can be estimated using a long run average return on the stock market. So we have to find a valuable stock, a valuable basket of stock, which can be used as proxy for the whole market. For example, in the US market, some researchers have been using the S&P 500, or some researchers have been using the Russell 1000 to represent the whole market. However, when we have finished calculating the market return, we can adjust that number up or down based on what investors expect the market to do in the next year. So we can have some adjustment regarding the market return here. There are several valuation models that allows us to find the intrinsic value. In this chapter, we will talk about the dividend discount model, and we will mention other approaches as well. First, we talk about the dividend valuation model or the dividend discounted model. In here, we have the denotions as DVM or dividend valuation model. This is an approach which holds the value of a shares of the stock as a function of its future dividends. So we will use a type of cash flow, and the cash flow will be the dividends. There are three versions of this valuation model. The first version, we will assume that the dividend will not grow over time, or we have the zero growth model. In the second version, we assume that the dividend will grow at a constant rate over time. For example, it will grow at 6% per year and for a long time to infinity. And the last one, we may have a 3-stage or 2-stage dividend model, and we have a variable growth model. In this model, we assume that the dividend will grow for a certain rate for a couple of years, and then it can have a different growth rate for different range. The growth rate will vary over time. So in sum, we have three versions of the dividend valuation model, and we will talk about them in the next slide. We have the zero growth model. So according to the zero growth model, we assume that the dividend will not grow over time. It means that we'll pay the exact amount of money years by years, and the growth rate of the dividend equal to 0. So in order to get the intrinsic value using the zero growth model, we just simply using the present value of annual dividends, or we use the annual dividends and divide by the required rate of return, and we get the value of the shares. The second version of the dividend valuation model, we have a constant growth. according to this version, we assume that the dividend will grow over time at a specified rate, and we get the denotation as G. G will be representing the growth rate. In order to find the value of a stock, we have equation 8.8. The value of the share equal to the next year dividend. You should bear in mind that it is the next year, not this year dividend, and divided by the difference between required return and dividend growth rate. Or we have this formula. Or we can make variations here. The V, or the value of the shares, equal to the D0, or the this year dividend, multiply with 1 plus G, 1 plus growth rate, divided by R minus G. So they are the same. When to use these versions of dividend valuation model? This model will be best suited for the valuation of large cap or mature mid-cap companies, because those type of companies had been established their dividend policies, and it is quite predictable for the analyst to estimate the dividend growth over time. So we better using these versions of dividend valuations model for those type of companies. So how do we find the dividend growth rates? It is kind of a key assumptions we have to make when we use the constant growth versions here. So in order to estimate the dividend growth rate, first we better take a look at the historical behavior of dividends by seeing the company annual report, or we see various online sources, or we have the report from the securities company. So we can have a better pictures of how the company has paid dividend over the years, and how the company show their attitude towards the dividend payment over the year. And we can calculate the average rate of growth in the dividend to see how much the company have paid. Does that amount of money have been growing over time? So basically, we just use the simple average, arithmetic average to find the growth rate in dividends. And we can calculate that, and we use our judgment based on the perspectives, how the company see the dividend payment scheme. And from that, we can have our own judgment, our own assumptions about the dividend growth rate. And another thing to remember when we use the constant growth versions is that this model, it implies that the stock price will grow over time at the same rate as dividend growth, and the growth rate plus the dividend yield will equal the required rate of return. So that's another thing to remember. And the third versions of dividend valuation model, we have the variable growth. This version allows for variable rates of growth in dividend over time. For example, if a company have been growing hot for a couple of years, it can decide to pay a quite low dividend. However, when the company reaches to a more mature stage, it can increase the dividend payment for a long time in the future. So it can have variable rates of growth in dividends. And this version will allow us to find the intrinsic value of those type of company. So we have the equation 8.9. The value of shares of the stock will equal to the present value of future dividend during the initial variable growth rate plus the present value of the stock at the end of variable growth stage. So in here we have the present value of all the dividend have been paid from year 1 to year V, and this is the present value of all the future cash flow from year V to infinity. So what type of company will be suitable for using this version of dividend valuation model?
This type of version will be appropriate for companies that are expected to experience rapid or variable rate of growth for a time, maybe 3 or 5 years, and then settle down to a more stable growth rate thereafter. So in order to use this model, what would you like to do? The first, you have to estimate the annual dividend using during the initial variable growth period. And in this period, you have to specify a constant growth rate, or we have the G here, that the dividends will grow at after the initial period. And the second step, you find the present value of the dividends expected during the initial period. The third step, using the constant growth dividend valuation model to find the price of the stock at the end of initial growth rate. Basically, it is the present value of owner cash flow at the end of initial growth period. And then at the fourth step, you find the present value of the price from constant growth period by discounting the price you find in step 3 to the year of valuation. And at step 5, you sum you find the summations of the two present value, and you will get the intrinsic value of the stock. So this is an example of how to evaluate a company using the variable growth dividend valuation model. The most recent dividend in 2015, and the future dividend will start in 2016 to 2018. And from 2018, the dividend will grow at the growth rate of 3%. And the required return is 11%. So first we have to find the present value of all the future cash flow from the during the initial variable growth period. We have the dividend here. We have the 3 dividend here. We discount them to 2015, and we sum them up, and we find this is their present value. The next step is to find the price of the stock at 2018 by using the dividend of 2019 divided by R minus G. And this formula equal to the dividend of 2018 multiplied with 1 plus G, not minus G. This one is a mistake. So it should be 1.03 or 3% growth here. And divided by R minus G, this one is correct. And you find this is the price of the stock at the end of 2018. Once we get this price, we discount it back to 2015 by divided by 1 plus 11% root for 3, and we get this one. And then we sum 32.76 with this one, and we get this one will be the intrinsic value of this stock using the variable growth model. We have talked about how to estimate the growth rate of dividend. However, this is one of the most difficult and, of course, one of the most important aspects of the dividend discount model. Because this type of estimations or the growth rate has an enormous impact on the value or the intrinsic value we will get. When we adjust a little bit the growth rate, it will have a greater impact on the intrinsic value we will get. And once it had an impact on the intrinsic value, it will have a greater influence on our investment decisions. And another difficulty we have to encounter when it comes to anticipating the growth rate is that we only have the historical data to look at. However, the historical data show us no clue that how the company will pay dividend in the future. So in order to tackle the issues we have raised, we have a formula here, which is the equation 8.10. We can use that to estimate the growth rate. So according to this approach, we assume that the future dividend growth rate will depend on the rate of return or the rate of equity and the fractions of earnings managers reinvest in the company, or we call it the firm retention rate. This retention rate will equal to 1 minus the dividend payout ratio. In addition to the dividend valuation model, the market has developed other approaches to value stock. For example, we have the free cash flow, and to be more specific, we have free cash flow to equity, which is FCFE, or the cash flow to the firm, or FCFF. So according to this method, we estimate cash flow that a firm generates to common stockholders, or the cash flow that a firm generates for both the common stockholders and the creditors, whether or not those cash flow can be used to pay dividend or not. So this is the first another approach. And the second one, we can use relative valuations, and one of the most popular relative valuations we have here is the PE approach. We build the stock valuation process around the stock price to earning ratio. And the major advantages is that these approaches do not rely on dividends as the primary input. In here we have the free cash flow to equity, or we have FCFE model. So according to free cash flow to equity method, we estimate the cash flow company generates over time for its shareholders, and we discount those cash flow to present to determine the company's total equity value. So the free cash flow to equity, or the FCFE here, is defined as the cash flow remaining after the firm pays all of its expenses and makes necessary investment in working capital and in fixed assets. So in here we have the value of the shares equal to the cash flow here, and we discount the cash flow to the valuation time. And the free cash flow here is defined as the after-tax earning plus any non-cash expense, for example, depreciations and amortizations, and we minus the investment in working capital and investment in fixed assets, and we will get the FCFE. There are some things to keep in mind when it comes to the free cash flow to equity valuation approach. According to this approach, is required forecast of the cash flow going to equity, and it's quite far into the future as well. And the formula, you can see that it's quite similar to the dividend growth model, except that in this approach, we use another type of cash flow, which is the free cash flow to equity. And in the dividend valuation model, we use the cash flow, which is the dividend. And in the dividend discount model, we can assume free cash flow remain constant over time, and we can assume that it can grow at a constant rate, or we can assume that it grows at a variable rate. So it's kind of similar to the dividend discount model. So in the free cash flow to equity approach, we still have three versions here: the zero growth, constant growth, and variable growth. Another thing to determine is the discount rate, and we can use the internal rate of return, or IRR, to find the expected return. Some investors prefer to find the expected return of a stock given its current market price, rather than estimate the stock intrinsic value. In order to get the expected return using the internal rate of return, we can use a method called trial and error, or we have it interpolation. We can use this approach to find the discount rate. And according to this method, trial and error, we just tried a different discount rates. And once we find a rate that equates the present value of the company future free cash flow to the current market value of the firm common stock, it is the expected return we have been seeking for. So once we having estimated the stock expected return, we can decide if that return is sufficient to justify buying the stock given its risk. Another approach to stock valuations, we have relative valuations, and one of the most popular one we have the price to earning or PE approach. It is a very simple approach and much simpler than a dividend valuation model or free cash flow to equity model. Because it's simple and it takes less time, it is kind of a favorite of professional security analysts, and it is widely used in practice. Basically, you just estimate the EPS or earning per shares, you estimate the PE ratios, and you multiply them, and you get the stock price you need. And it is customary to use the forecasted EPS for the next year. For example, like projected earnings 1 year out. So this approach or PE approach and other price relative procedures base their valuations on assumptions that the value of the stock is directly linked to a performance characteristic. It can be price to cash flow, it can be price to sales, or it can be price to book value. And this type of approach involves a good deal of judgment and intuitions, and it relies heavily on the market expertise of the analysts of the firm. So we have other price relative procedures, and one we have here is the price to cash flow procedures. This procedure is quite similar to the PE approach, but in these procedures, we substitute the earning per shares by the projected cash flow for earnings. The investor who use these procedures believe that the cash flow will provide a better pictures of the company's true value than the earnings, so they will use the cash flow per shares. And in the equation 8.13, we have the formula to calculate the P to cash flow ratio. It is equal to the market price of the common stock here divided by the cash flow per shares. We can use different type of cash flow. We can use the cash flow from operating activities. We can use a free cash flow, or we can use the EBITDA here, or earnings before interest, tax, depreciations, and amortizations. This type of cash flow is the most popular use. We also have the price to sale and the price to book value ratios. Once again, it's similar to the PE approach, but we just use a substitute. In here, we use the sales and we use the book value per shares to substitute for earnings. This type of approach will be useful for companies with no earnings or the earnings is quite volatile. So it is quite difficult to predict the earnings. So in order to predict earnings, the analyst or the investor can predict the sales or predict book value per shares instead. So we have equation 8.14 here. We calculate the price to sale ratios, and we have the price to book value per share ratio. And we can use the same approach as PE approach. So that's the end of chapter 8. In this chapter, I have explained the role that companies' futures plays in the stock valuation process. We have talking about how to develop a forecast of a stock expected cash flow. We start with the sales and earning estimates, and then we move to expected dividends and share price. We have discussed the concept of intrinsic value and required return and note how they are used. We have tried to determine the underlying value of a stock. using the zero growth, constant growth, and variable growth dividend valuation models. We also talk about other types of present value-based model to find the value of the stock, as well as alternative price relative procedures. And I hope that you, after this chapter, have been able to understand the procedures used to value different types of stock, from traditional dividend paying shares to more growth oriented stocks.